Welcome to Module 5, everyone. We're going to discuss a concept that I believe is never addressed in any of the standard textbook references, which is something I'm going to refer to as the MACD trend cycle. What we're talking about really is just a very systematic way of making sense of the various behaviors, events, signals, readings that MACD will tend to put in as it oscillates from one extremity to the other. Now, we noted at the very outset of this course that just because you have what looks to be a very dramatic looking crossover way above the waterline, that it doesn't necessarily mean a bearish reversal. So what we're talking about here is those instances where we have done our homework and we've concluded that a crossover on one side of the waterline leading to the other is in context of a valid reversal. And so MACD will typically do the same sorts of things from one crossover to the oscillation on the other side of the waterline. So that's the paradigm we're talking about here. And this can be useful for helping us to follow or monitor the trend, to determine the health of the trend, to monitor existing open positions we might have on the trade, to add to a position if we wish, and to make sense of readings on other indicators, either because they are possibly ambiguous or if they're indicating something counter-trend. MACD is a very good trend-following indicator, and so we're going to look at the different ways it helps us to do that from one extremity to the other, overbought to oversold, and vice versa. The chart examples we're going to use to illustrate the trend cycle concept on MACD are all going to come from the exact same chart, just to avoid kind of the distraction or confusion that would result if we're bopping around between a whole bunch of different charts. So the chart example we're going to use is the British Pound US Dollar daily chart with a time frame of roughly January to July 2007. The trending indicators we're going to use will consist of the Guppy multiple moving average system, which comprises these two sets of exponential moving averages with the period settings as shown, a 200 period EMA, which is the gold line, and then we're going to revisit this concept we looked at in Module 3 of a two-panel MACD setting, a slow panel with a 40-80-10 period setting, which provides superlative trend following characteristics, and then a faster panel which outlines pullbacks and continuations along the way, and reading those two indicator panels off of each other. Okay, the very first event that initiates this trend cycle concept when MACD is oscillating above and below the waterline is when MACD crosses the trigger line. So as we noted earlier on, that can potentially indicate a change in momentum from bullish to bearish or bearish to bullish. And for the illustration we're using, we're showing crossovers happening on either side of the waterline rather than those exceptions we noted earlier where you can have it close to the waterline or even on the waterline. What is your trade bias when you see a crossover event? Well, there are two types really that we're going to consider. One is a continuation crossover, which means we have a higher level trend that remains intact. And so if we have, say, a bullish crossover below the waterline, that's giving us an opportunity to get back into the prevailing trend, buying the dip or selling the rally. Conversely, if you have a really robust confluence of reversal signals, chart patterns, candle patterns, divergences, and so forth, it may be not necessarily the continuation of a trend, but rather the start of a new trend. So those are two generic kind of biases you might want to consider when you see this initiating event. So let's look at the chart example to show more clearly what we're talking about here. Okay, this is event number 1 in our trend cycle concept, and I'm just going to give you a little hint. What we're going to outline from start to finish is a crossover from here, below the waterline, to a crossover here, above the waterline. Okay, so the initiating event in this trend cycle concept is this bullish crossover here, and that is confirmed by the first histogram bar to paint in on the opposite side of the waterline on a close. So this is a confirmed crossover. And what we can see happening here is that this is another example of the power of having the proper bias established before we even think about drawing a trend line. In this case, we knew that the gold 200 period moving average had been trending up for a very long period of time, so therefore we could conclude that this move to the downside was counter trend, and therefore a bullish crossover validating a supply trend line was a good thing to look at because it was not counter trend, it was with the trend. So this started our trend cycle concept here, this bullish crossover, and now we're thinking long in line with the prevailing uptrend. So the first event that will happen after a valid crossover in a reversal context is the increasing angle and separation of MACD relative to its trigger. So by angle, we mean, of course, is it pointing up or down with some good slope? And by separation, we mean the physical gap between the two lines, MACD and its trigger. So as that happens, what's really going on is that the two EMAs from which MACD is constructed, for example, a 12 and a 26 period EMA, the gap between them is increasing, and this in turn implies increasing momentum for the move that has been signaled by the crossover event. So at this point, what's your trade bias? Well, if you're not already in the trade, you'll want to be looking for your first confluence of really rock solid signals to tell you it's a good time to buy the dip in an uptrend or sell the rally in a downtrend. In our example, we're looking at a daily chart, so of course you'll want to drill down to a whole bunch of intraday charts to get a good entry point against it. From a trend monitoring perspective, what this event is saying is that the trend cycle is still more or less in its infancy. Just after the crossover with increasing angle and separation, there's probably going to be not much chance of a reversal as long as those two lines on MACD are pointing up or down with very clear angle. So let's take a look at a chart example, the chart example, which demonstrates that. Okay, so here again is the initiating crossover, and what I've done is I've just drawn in a pair of parallel vertical lines. And what this does is kind of outline that initial sequence after the crossover in which MACD attains good angle and separation. You can see that after the crossover up to about this point here, MACD is pointing really sharply in the upwards direction, and all the way through here it's attaining increasing physical gap relative to its trigger line. You really don't want to be entertaining short thoughts against a sequence like this. There's just no signs of weakness when MACD is behaving this way. And similarly, just for the sake of completion, I've outlined the other crossovers on this chart, the more obvious ones anyway. And we can see the same sort of thing happens. Right after the crossover, we get MACD punching either down or up fairly sharply, and as it does so, it attains increasing physical separation relative to the trigger line. Here, and again here, there's a sequence where it's increasing, and then again here, just after the crossover, we can see nice sharp angle up, increasing separation relative to the trigger. There's no signs of a reversal in the opposite direction in each of those initiating sequences here. So that's what increasing angle and separation after a valid trend reversal crossover will tend to look like. Okay, here what we've done is we've actually drilled down to a 60-minute view on the AccuCharts platform once we've seen that angle and separation attribute setting in on the daily chart, which we just looked at. So we see the reversal crossover back in line with the prevailing uptrend. We see angle and separation. We're saying to ourselves, okay, if we're not yet in this trend, let's look for some signals to do so. So here on the 60-minute chart, what we've done is we've cobbled together a nice confluence of events that collectively allow us to jump into the long side. So the first thing we see from bottom to top, stochastics %K, which is the red line, has crossed over the %D line heading up and then through its 20% oversold boundary, which is an inherently bullish signal. Our good friend Mr. MACD has crossed over its trigger from below the waterline. RSI came close to its 30% oversold boundary, did not quite touch down or through it, but in context of these other indicators, that's how we're going to read it. it's crossing over bullish from below its 50% line. So we're going to interpret that as a bullish confluence. And then, of course, we've drawn this supply trend line break right here, and just at the point that price breaks that trend line, the guppy fast-moving averages cross over the slow and then start to attain angle and separation from each other in the upwards direction. So we saw the reversal crossover, we saw the angle and separation on the daily chart. So we're drilling down, and this 60-minute chart gives us a really excellent confluence of events to jump into the trade to the long side, and we can see what happened after that. Pretty predictable. So a really nice example of the top-down multiple time frame approach once again. Okay, so from one oscillation to the next, after MACD has crossed over and attained its initial angle and separation, what will tend to happen next is MACD will go ahead and penetrate through the waterline, which is that horizontal zero line in the middle of the panel. What does this mean? What's going on? Well, the underlying theory is that what you have is essentially nothing more nor less than a crossover of the two moving averages from which MACD is constructed. So what you might want to do is just an interesting homework assignment. Take a chart, plot a 12 and a 26 period EMA on price and a 12-26-9 MACD underneath. Circle all the instances in which MACD crosses the trigger line. Then draw a vertical line up to price and see what the two moving averages are doing. What you'll see in every single instance is the 12 and 26 EMAs crossing over each other, coinciding with a break of MACD through the waterline. So simply put, we're looking at a moving average crossover, it just depicted slightly differently. And what this will tend to indicate is that the trend that was initially signaled by the crossover of MACD, it is indeed real. You know, this is just a secondary confirmation signal. Sometimes some conservative traders will often not even work with the initial crossover. What they'll do is wait for this breach of MACD through the waterline. It all depends on what your personal approach is. The danger of this is that you will possibly be leaving some pips on the table by getting in later, and you will possibly also run the risk of getting in closer to the end of the move. But it is a good conservative signal, and what you might want to do is, if you are already into the trade and you have one profitable position, when MACD penetrates the waterline, you could give consideration to looking for some signals, again drilling down to a lower level time frame to look at the possibility of adding to your position. Okay, well, actually, I went ahead and did your homework assignment for you. What we're going to do is just outline a couple of instances. We're matching up behavior of MACD to the underlying moving averages. So here we have an example of MACD penetrating the waterline, and we can see that at the exact moment it does so, the moving averages, the 8 and 24 period EMAs, which underlie the 8-24-9 setting MACD, the fast-moving average is crossing over the slow-moving average, and being that this is a daily chart, as long as these two lines maintained good positive physical angle and separation, that was giving you another prevailing upward bias, and you could again drill down to lower level time frames to pick an entry point in line with this little up move here. Another example in the counter trend direction, we've got the 8 crossing back down through the 24, and at the time that exact moment it does so, MACD is again penetrating through its waterline. But in this example, in the counter trend direction, which we probably wouldn't want to trade. So this is what I would have done when I saw MACD breaching the waterline to the upside on the daily chart we just looked at. I would have drilled down, and one of the first charts I would have seen was this 3-hour chart. And unfortunately, it was not telling me good news as far as the opportunity to buy a dip. What happened was we had price breach the Bollinger Band, a Bollinger tag. We had RSI go pretty severely overbought, hitting almost the 100% level, which is extremely overbought. We had stochastics hit 100%, and we had negative divergence on MACD to price. So if I'm thinking buy the dip, this is really not a good time frame to do so. And what I had to do instead was go over all the way over to the right-hand side of the chart here, which is quite a lengthy passage of time here to wait patiently for a good basic opportunity to buy into the prevailing uptrend. And that came over here, some signals telling me to think long. Our RSI now having gone severely oversold, punching back up through its 30% line. Stochastic similarly going oversold, %K crossing over %D over the 20% oversold territory, and then MACD punching up and through its trigger pretty sharply. And again, angle and separation opening up as the move started to pick up speed. So you can see that I had to wait a number of days after MACD breached the waterline on the daily chart before I had a good basic setup to go along again. So again, the power of top-down analysis, both for pegging good entry points and also to signal when it's not a good time to trade, even with the trend.